Welcome to Undercover Analyst. The European Central Bank raised its key interest rate to an all-time record high levels on September 14 and signaled that this will likely be its final move with more than a year-long fight against the high inflation. Now, the decision raises the ECB benchmark deposit rates to 4%. And that's a big move because if you consider just a year ago, it was like at minus 0.5%. So a change from 0.5% to 4% is a huge move. And right now, the 4% is actually the highest ever since the euro was established in 1999. So the rate of the main financing operations in the Eurozone now climbs to 4.5%. The marginal lending facility is now up to 4.75%. It marked the 10th straight increase since the central bank launched the most aggressive hiking policy in the history, and this was after the Russia's invasion of Ukraine. Economists and investors struggled to anticipate this result earlier when President Christine Lagarde last month said that there was no intention of such a rate hike. So this took the analysts and economists by surprise. And ahead of the meeting, analysts were sharply divided over whether the ECB would lift the rates or might just leave it unchanged because there has been an economic strain in the 20 countries from the Eurozone. Against the backdrop, the ECB sent clear message that it is probably done with raising rates and probably would not increase rates ahead. Based on the current assessment, the ECB interest rates have now reached to levels which might be which might be sufficient for a long duration, because you cannot just keep on increasing the interest rate with the fight against inflation, because that will impact the economic growth of this region. Future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels. That's what Christine Lagarde said, adding that policymakers will keep relying on available data. So now this is a confusion here because it's a clear indication that the interest rates will not go up, according to Christine Lagarde. But anything can happen. I mean, if the target rate is 2% inflation for the ECB zone and that doesn't work out, then that could be, we could see more rate hikes coming in. Now, what happens when you raise the interest rate? It's very easy to just raise the interest rate and tame the inflation, which is already going very high. But what it happens is with that, you have to compromise on the economic growth. That's a simple economics. And the ECB has cut its growth forecast for the Eurozone over the next 3 years because they know that they'll be facing a tougher financing conditions. And these financing conditions are expected to dampen the domestic demand. And at the time when the international trade is already weakening, we have just come out of the COVID-19 pandemic, and the eurozone was starting to show positive signs of growth. But this inflation has now turned out to be the villain, and we have to tame the inflation because it just keeps the value of money eroding the value of money, and that's a big problem here. The eurozone economy is now expected to expand just by 0.7% this year, 1% for the year 2024, and 1.5% for 2025. The Eurozone economy has been teetering on the edge of recession since last year. The growth was only 0.1% in the past 2 quarters. So already the Eurozone was not in a good shape, and this rate hike might cause some problem because it will be difficult for companies and individuals to raise cash or to raise debt because that will be costlier debt now. The new economic projection fears stokes of stagflation. Now, what is stagflation? Stagflation is economic stagnation with increasing inflation. Now, that's not going to do good to anyone. Economic stagnation, the economy is not growing, and you still have high inflation. And we have seen that in the past. The ECB also said that the Eurozone inflation was expected to remain too high for too long. That's the phrase which was used, too high for too long. The inflation is just forecasted to be lowered in 2025, but still the 2% rate is nowhere near what the ECB has proposed. ECB sees inflation reaching 5.6% in 2023, 3.2% in 2024, and then maybe ease it to 2.1% in 2025. So still, if after the rate hikes, it's going to be 3 years that the European Central Bank is expecting the inflation to come down to their target of 2%. And that says that this inflation is going to stick for a longer time than expected. The annual inflation of 5.3% in 20 countries of the Eurozone is well above the bank's target of 2%, and that's the problem. So 20 countries of all the countries in the Eurozone have an annual inflation of 5.3% on average. Now, this is troubling consumers over purchasing power, and this is also contributing to an economic stagnation, which means the economy is not able to go up, which has already just increased by 0.1% in the past 2 quarters. What's weighing on the Eurozone's growth outlook? The major economies like Germany, France, Spain, and Italy all have seen shrinking activity in August in the services sector. Now, this is a big surprise because usually at this point, the services sector is usually booming because of vacation, which is happening in the Europe. But the thing is, we have already seen a slowdown in services sector, and on top of that there is a slowdown in global manufacturing that's hitting Germany, Europe's biggest economy. Now, the Eurozone economy has been teetering on the edge of recession, like I said earlier, growing only 0.1%. So what happens when the services go down and the manufacturing go down at the same point when you only have 0.1% growth? That's going to be really bad for the ECB, because they would not be able to handle this, because they are targeting to come down on the inflation, and that will severely impact the economic growth. The economic picture of Europe does not resemble a typical recession as of now, because the unemployment is at record low. But what happens when more people are employed into the system, employed into the economy, and the wage rate keeps going up? So if the wage rate keeps going up, the inflation will not go down. So it's a very tricky situation. It's a catch-22 situation for the ECB. Also weighing on the outlook is a weaker euro against the strengthening US dollar. And economic weakness has already hit Europe and China. And what's happening is the US is now expecting for a soft landing, which is taking the dollar up against the euro. So there is a lot of problems coming in the Eurozone. Interest rates combat inflation by raising the cost of credit, and that's the problem here. I mean, particularly buying houses or doing business investments in buildings and equipment, all this are going to go up, and it cools off demand for goods and services. It relieves upward pressure on prices though. However, the downside is that the rate hikes can turn economic growth into a into a bad position, which is already not in a very comfortable position. As far as the markets are concerned, the markets actually cheered the rate hike and thinking that this would take the inflation down. And the Euro stocks was like up 1.52%. That's like a considerable upside when you consider that the economic outlook might be bleak considering this rate hike. Central Bank of China announced it would cut reserve requirement ratio. So what is happening here is the Eurozone and China are on a similar page. That's what I think, because they the problem with the Eurozone is the high inflation is forcing the ECB to increase the interest rates. At the same time, the economic growth, which is already just tipping above recession. I mean, it's just on the borderline of recession, might get into the recession zone. If you like this video, please share, subscribe,